Sunday, January 18th, 2026. Welcome back to the Deep Dive.
Good to be here.
You know, usually Sundays are for coffee, maybe a slow read of the papers.
Right.
But if you've been plugged into the financial news cycle over the last 48 hours, you know that slow just isn't an option right now.
Not at all.
The markets might be technically closed, but the machinery behind them, it feels like it's spinning so fast it's vibrating.
It really does. I mean, we usually try to pick a single theme for these deep dives, you know?
Yeah, like the future of AI or the energy crisis.
Exactly.
Yeah.
But today, just looking at the stack of research we have, we are staring at this singular juncture in financial history. It's not just one story.
No, it's a collision. It's a collision of like 3 or 4 massive historical threads all tangling up at once.
That's a great way to put it.
It feels like we're walking a tightrope. On one side, you look at the data, the American economic engine is just roaring.
Jobs up, private sector is booming.
Right. But on the other side, the institutional framework, the stuff we trust to keep the lights on, it's shaking badly.
We're talking a criminal probe into the Federal Reserve, tariffs being threatened over buying an island, and gold acting like the world is ending.
It is the perfect way to frame it. An unstable equilibrium. We are seeing this divergence between the, let's call it the real economy,
The business is making stuff.
and the institutional economy, which seems to be having a complete nervous breakdown.
So our mission today is to try and make some sense of that divergence. We have a huge stack to get through.
We do. Market analysis from mid-January, earnings previews for next week, a breakdown of this so-called Trump tariff playbook, and some heavy macroeconomic commentary.
And we should warn you, some of these numbers they're just contradictory. We're seeing stock market highs at the same time as this money tsunami and the plumbing of the banks.
And a 14% surge in foreclosures?
Which should not be happening at the same time.
Yeah.
But here we are. So let's start with a story that I think actually scared the most people this week, the Fed.
The Federal Reserve, yeah. And we're not just talking interest rates here. We're talking about a war between the White House and the central bank.
Right. This is that institutional fragility piece.
Right.
On Monday, January 12th, the news broke.
The DOJ.
The Department of Justice launched a criminal investigation into Fed Chair Jerome Powell. Now, historically, the Fed is supposed to be independent.
Untouchable. Politically untouchable.
But the DOJ is under the executive branch. So this looks like a raid.
It does.
Exactly. The official reason, the headline is about building renovation comment.
Right. An administrative issue.
Which nobody in the market believes is the real reason. Powell himself called it pretextual.
So what's the consensus?
The analysis we read all points to a pressure campaign, a campaign to force rate cuts. The data doesn't support a cut, so the administration is trying to force his hand.
And the market's reaction was just immediate nausea.
Yeah.
The VIX, the fear gauge, it jumped over 4%.
And the Dow swung 500 points in a single session.
But I want to dig deeper than just the stock prices. The scary part wasn't the Dow, it was what happened in the plumbing you mentioned.
The repo market, yes. And we have to get technical for a second because this is where financial crises actually start. The repo market is, it's like the pawn shop for the banking system.
Right. Banks lend cash to each other overnight just to balance their books.
Using treasury bonds as collateral. It's supposed to be boring. It's supposed to be seamless.
But on Tuesday, it was not boring.
No. Private repo rates hit 3.9%. That's way higher than where the Fed wants them.
And when that rate spikes, what does that signal?
It means banks are suddenly terrified to lend to each other. They're hoarding cash.
Okay, so connect the dots for us. The DOJ investigates Powell on Monday. Tuesday, the banks start lending to each other. Is that cause and effect?
It is highly correlated. I mean, look, if you're a bank and you see the head of the central bank, the lender of last resort, under a criminal investigation, you start wondering if the system is stable.
You hold on to your cash.
You hold your cash. And because the banks stopped lending, the Fed had to step in with a massive defibrillator.
The liquidity injection.
A $55.3 billion injection into the repo markets just starting last Tuesday. And the plan calls for $165.9 billion over 3 weeks.
So for everyone listening, $55 billion isn't just topping off the tank?
No. This is emergency surgery. It's the largest injection since the pandemic era. They are flooding the system with cash to keep the gears from seizing up.
Because the private bank's locked up.
Exactly. It's a way to stabilize the plumbing while the political leadership is at war. It just shows how fragile confidence is right now.
You know, I have to pause here, because this is exactly why we do this show.
Yeah.
Most headlines just said, Dow volatile on Fed news. But the real story was $55 billion being printed to stop the banking gears from seizing. It is incredibly difficult to keep track of this when it moves this fast.
It feels like weeks of news happening in hours.
Precisely. So if you are finding value in us connecting these dots, from the DOJ probe to the repo spike, do us a quick favor.
It really helps.
It does. Subscribe to the channel, like the show, or leave a comment. It helps the algorithm find other people who need to know what's really going on with their money. We want to keep building these deep dives, and your support makes that happen.
And honestly, with what's coming next, you are going to want to stay tuned.
Speaking of what's coming, we have to pivot to the international stage. Because if the domestic situation is tense, the geopolitical situation has gone fully surreal.
It really has.
Saturday, the notification pops up on my phone. Greenland.
The Greenland tariff ultimatum.
I still struggle to wrap my head around this. President Trump announced a 10% tariff on 8 European nations.
Denmark, Norway, Sweden, France, Germany, the UK, Netherlands, Finland. Basically our key allies.
Starting February 1st. And this isn't about steel or aluminum.
No, it is explicitly about the complete and total purchase of Greenland.
It sounds like a real estate deal gone wrong, but played out with national economies.
It's strategy masked as real estate. The U.S. wants Greenland for 2 very specific reasons, according to our sources.
Okay.
1, the Golden Dome missile defense system. Greenland is geostrategically perfect for shielding North America. And 2, rare earth minerals.
An untapped vault.
Exactly. A vault of resources the U.S. needs for the next century of tech hardware.
But threatening the economies of our closest allies? France is calling it a dangerous downward spiral. Denmark is deploying troops.
I saw that.
This feels like the alliance is fracturing.
It looks that way on the surface.
Yeah.
We have a fascinating breakdown from the Kobesi letter that suggests we shouldn't take this at face value.
They call it the Trump tariff playbook, so they think this is a script.
A negotiated script. Look at the timing. Step 1, threaten on a weekend. Why Saturday?
Markets are closed.
Markets are closed. You drop a bomb when no one can trade, so the psychological pressure just builds for 48 hours.
Everyone just stews in the panic.
Yes. Step 2, markets drop. When futures open tonight or tomorrow, we expect a sell-off.
Yeah.
That financial pain puts pressure on European leaders to come to the table.
Then what?
Step 3, negotiation and, teasing progress. And finally, step 4, a deal is struck. Maybe not for the whole island, but for rights or bases. And the tariffs get delayed or canceled.
So the argument is he doesn't actually want the tariffs. He wants the leverage.
Exactly. But it's a high-risk game. If Europe calls the bluff or retaliates, you get a trade war that spikes inflation right when the Fed is already on the ropes.
It seems like the theme of 2026 is just high stakes, and that bleeds into domestic policy too. We had that proposal on Tuesday to cap credit card interest rates at 10%.
Which sent the bank stocks off a cliff.
Yeah.
Capital One dropped nearly 7%.
Sounds great for consumers, but for the financial sector, that's a revenue nuke. However, amidst all this, the chaos, the threats, we have a contrarian view in the stack today.
Daniel Lacal.
Yeah. He argues we're looking at this all wrong.
This was one of the most interesting reads. Lacal argues that despite the noise, the U.S. is actually leaving the G7 in the dust. He draws a really sharp line between supply-side growth and demand-side growth.
Okay, we hear those terms a lot. Break that down for someone who isn't an economist. What's the real difference?
Think of it like physical health. Demand-side stimulus. What Europe and China are doing is like eating a candy bar for energy.
Okay.
You pump money into the system, that's the sugar. You get a quick burst of activity, but it's not sustainable. And it leads to a crash or, inflation.
And supply side.
Supply side is going to the gym and building muscle. It's cutting taxes, removing regulations, making it easier to produce things. Lacal argues the U.S. is building muscle.
How?
He notes that U.S. government jobs are down by 279,000, while private sector jobs are up. We are shedding the fat and building muscle.
So even though the deficit is high, he sees it dropping to $500 billion in 2026 because the economy is just more productive.
That's the argument. He points out that real net wages are rising faster than inflation. That's the key metric. If money supply is growing because businesses are borrowing to build factories, which they are, that's productive money.
Not just printing cash.
Right. So his view is, ignore the political circus. The American economic machine is the cleanest shirt in the dirty laundry basket of the global economy.
But even the cleanest shirt is getting wrinkled, because if the U.S. economy is so strong, why is everyone fleeing to assets that have nothing to do with the U.S. dollar?
This is the faith haven trade.
We have to talk about this hardware versus software dynamic.
We do. Gold hit a record. $4,639 announced this week.
$4,600, that's double where it was just a few years ago.
And it's not just inflation. People are buying gold because it is a physical asset. It's hardware that can't be debased by a central bank or frozen by a government sanction.
So when you see the DOJ fighting the Fed,
you lose faith in the software of the system, the fiat currency. You want the rock.
And then there's the digital rock, Bitcoin, trading near what, $97,000?
Around there, yeah. But there was a specific technical update this week that I think flew under the radar for most people, but is actually huge.
The Bitcoin quantum testnet.
This is a massive deal.
Yeah.
We've talked about the threat of quantum computing for years. The idea that a supercomputer could eventually crack the encryption that secures Bitcoin.
The theoretical Y2K for crypto.
It's like a ticking time bomb.
Right.
There are about 6.26 million Bitcoin worth $2 trillion sitting in these old legacy addresses.
Where the public keys are visible.
Exactly. A quantum computer could theoretically just steal that money.
So what's the testnet doing?
It's the sandbox. It's where developers are testing the fix. The fact that they launched it on January 12 means the network is taking the threat seriously and building the immune system to fight it. It de-risks the asset in a big way.
And Ethereum isn't sitting still either. They had the BPO hard fork, and I love this term. They raised the blob limit to 21.
Blobs. It sounds ridiculous, but think of it like an HOV lane on a highway. Before blobs, all the data transactions, smart contracts, everything was stuck in the same traffic.
Okay.
Blobs create a separate, cheap lane just for big data chunks. Raising the limit to 21 cuts the fees on Layer 2 networks by 60%.
So using the network got 60% cheaper overnight.
Basically, yeah. So while the politicians are fighting over Greenland, the technological hardware of the financial system is getting upgraded faster and cheaper.
Okay, we've covered the high-flying tech, the gold, the politics, but we need to come back down to earth because there is a statistic in this stack that is just a massive reality check.
The foreclosure report, this is the sobering counterweight to the stock market highs.
Foreclosure filings in 2025 rose 14% to over 367,000 properties.
A 14% jump. That's not a rounding error.
No.
It's significant. We've only seen a jump that large 4 times since the 1980s. It signals that we're overshooting the normalization after the pandemic.
It's concentrated, right?
Florida is the epicenter. 1 in every 230 housing units has a filing.
Think about that. Walk down a street in a subdivision, one house on every block or two is in trouble.
That destroys the wealth effect. You might see the S&P 500 at a record high, but if your neighbor is getting foreclosed on, you don't feel rich. You feel scared.
It creates a split-screen economy.
It does, where the asset stocks, gold, are booming. But the daily reality for the bottom 50% is getting harder.
Which brings us to the week ahead. We have this split screen playing out in real time starting tomorrow.
All eyes on Davos, the World Economic Forum. President Trump is heading there Monday.
Talk about walking into the lion's den. He just slapped tariffs on half the attendees.
It will be icy, but the markets will be watching for a blink. If he signals he's willing to negotiate on Greenland, we could see a relief rally.
And if he doubles down?
The tariff playbook suggests we get that market drop to apply pressure.
And on the corporate side, we have earnings. The big three, the report calls them.
Netflix, Intel, and J&J. They represent 3 different pillars.
Let's run through them. Netflix.
Netflix, up Tuesday, is the subscription economy check. Shares are struggling post-split. Investors need to see if that ad tier is actually working or if people are canceling.
Okay, Intel.
Intel is the hype check. The stock is up 140% in a year. That is entirely priced on the promise of the AI PC. If they don't deliver a convincing roadmap, that bubble could leak fast.
In Johnson & Johnson.
The consumer check. They sell Band-Aids, Tylenol, baby shampoo. If J&J misses on revenue, it confirms the foreclosure story, that the average American is tapped out and cutting back on essentials.
There is one last wild card we should mention, Venezuela, the arrest of Nicolas Maduro.
And the freezing of $700 million in assets. It's a geopolitical earthquake.
But the market impact might be small.
It might be muted, interestingly. Years ago, this would have spiked gas prices. But with the U.S. producing 13.8 million barrels a day, we're buffered. It's more of a diplomatic crisis than an economic one for us.
So let's try to synthesize all of this. We are 1 month into 2026. The private sector is strong building muscle, as Lacal says.
Right.
But the environment it operates in is just chaotic. We have the DOJ investigating the Fed. We have the president trying to buy an island. We have gold acting like a bunker.
It goes back to that hardware versus software idea.
Yeah.
If you look at what's winning right now, it's hardware.
Gold.
Gold, semiconductors, land, as in Greenland, oil, things you can touch, things that are physically scarce.
And the losers.
The software, the agreements, the treaties, the institutional trust, the banking regulations. In a world where the rules are being rewritten overnight, where the software of society is glitching, the market is telling us that safety lies in the physical.
That is a provocative thought to leave you with. In a digital world, the most valuable assets might be the ones you can actually hold in your hand.
It certainly looks that way this week.
Now, before we sign off, a necessary reminder. We have discussed highly volatile topics today. Leveraged trading, crypto, geopolitical plays.
We are not financial advisors. The risks here are very real. As we saw with the repo market, things can break in a matter of hours.
So do your own research. Check the sources yourself. And do not make decisions based solely on a deep dive like this.
Absolutely.
Stay curious, keep watching the plumbing, and we will see you on the next deep dive.
Take care, everyone.